So we have this fantastic panel of veterans from our industry. Just one clarification, they're veterans by knowledge, and by, you can see by the looks they are young. So, let's start this, discussion with them. So, now the first question is to Mr. Navneet here. We have seen the recent surge in stock market. Investors, they have earned better than expected returns. And so their expectations have, they have increased. So they want to adopt a T20 approach, but experts suggest test match strategy. So how do you manage such high expectations of investors in the given this scenario?
So I don't think the incremental money that's coming is coming with that T20 expectations, while the delivery will be like a test match, because a large part of the flows into mutual fund industry are in the form of SIP now, where it has been sold as a product where you accumulate or you kind of accumulate wealth over a period of time by being very disciplined and then keep investing every month. And if large part of the flows are coming in that form, then I think expectations have been managed right. At the same time, I'm sure there are investors who are looking at certain sector and thematic funds, or maybe a small cap fund which may have delivered a 50, 60, 70% and getting charmed by that return and just extrapolating. That's a human bias or whatever the recency bias that people may have. But the way industry is trying to position the product is that you accumulate wealth over a long period of time by being very disciplined. And you said the recent surge in market. I mean, in India, the surge has been there for a long time. As a small kid in 80s, I remember Sensex at 300-400 and have seen the journey to 80,000 now. And over the next several years, I think if India continues to deliver what it has delivered in last 10, 20, 30 years, I think investors will have good experience. If somebody is investing for next 6 months, looking at last 6 month return, there's a possibility they may have disappointment. But I think if somebody is doing in a highly disciplined manner over a longer period. I'll just give one example, and we'll take the opportunity. We didn't pay FE for the sponsorship, but I'll use this opportunity. If somebody did an SIP of 10,000 rupees per month in HDFC FlexiCap fund over the last 29 years, somebody did a 10,000 rupees per month over the last 29 years, that money would be 20 crore rupees today, close to 20 crore rupees. That's the power of compounding. That's what India has delivered. That's the power of like disciplined investing over a longer period. Of course, coming from mutual fund industry, I have to say past performance is no guarantee of future returns, because maybe the environment was a little different, but it just shows, I mean, the potential of India, and if you continue to invest in a disciplined manner, what it can deliver to investors. And this is what we are trying to sell investors.
What do you think, what's your advice, and how do you manage the investors' sentiments in the current scenario?
My advice would be to take all your money out of the HDFC Super Saver Fund and put it with ChrysCapital and Kedaara. On a more serious note, sir, thank you for having us. But I think our worry has always been that, bit what Navneet said at the very end, that past performance can be no guarantee for future performance. Having said that, if you look at the macro, the global trends, I think the next 10 years should be India's decade, right? So, and what better way to play it than equity and equity growth. The only thing that I would say is this whole concept of diversification, that even most people look at diversification as equity and debt, but even within equity, it's time that, our entire investor base, whether it's corporates, family offices, ultra net, high net worth, and retail, starts looking at diversification across different asset classes within equity. So a bit of putting money historically in Nifty, the Sensex, increasingly start looking at other asset classes within that, whether it's alternatives, whether it's venture, whether it's private equity, because over time, studies have proven that the diversification strategy will always give you a higher reward compared to the risk you take on a uni product. So again, no wisdom, no crystal balls. If we had that, we wouldn't be on this panel. But I think our best advice, and also to be a little bit measured, this may not be the best time to put all your savings in a new equity account that you've opened. So the counter side of the compounding is also a product like the SIP product is a good one because you average your entry price over time. Yeah? Nobody can say what's going to happen to the markets tomorrow. So if you put it all in today, probably not the smartest idea, but the SIP product is great to enter the markets. The question is, once you enter, what should you be investing it in? One can be plain equities, could be index funds, but as you grow more and more mature and you have the capacity to take risk, then take a higher risk with a more, a product which carries a higher reward.
Kunal, what do you think? Means there are opportunities, but what are the challenges it brings to you, wealth managers?
Yeah, so that may be a better question for Soumya to answer, but I'll just follow up on what Manish was saying. And like Kedaara, we're also investing in two pockets. One is a longer-term private equity product, and the other is a slightly shorter term, but still a mid-term oriented public equity product. And clearly the returns, if you look back over 3 years, 4 years in Indian stock market, have been very hard to match for most people. But I think it actually deludes investors into thinking this is what will continue. When you extrapolate from these levels, I think people are setting up the wrong expectations. And what's most important is to have realistic expectations. But in my mind, if you want to really create wealth over the long term, you have to focus on the number of years you want to compound, not just the X. Everybody says, oh, what return are you making? And the IRR becomes the benchmark to judge everybody. But if somebody can compound for twice as long as somebody else, that will end up creating a lot more wealth. So in that sense, I feel today's 1 year Sensex returns or 3 year Sensex returns is still not the right way because most people here would want to compound over 10 years or 15 years. And in that sense, what Manish was saying, which is, look, there is a case to be made to diversify. I think it's important to have that at the right point in the cycle for you. But one benefit that private equity has is it forces you to have a 10-year view because the product itself is 10 years. The data from the US and all markets shows that the average mutual fund investor underperforms the average mutual fund. Think about what that means. How is that possible? That's because investors end up selling at the wrong time, buying at the wrong time, and trying to time the market is not the right way to do it, right? So thinking long term is probably the best strategy you can have, the best de-risking you can have.
Right. So Soumya, now talk about the challenges. What's your view on this?
Yeah. So thank you for having me on the panel. I think what happens in the scenario we're seeing right now is that the investor experience in markets is actually quite short. You've had a whole number of retail investors or otherwise who've just been investing maybe over the last 2 to 4 years. And that's quite short when you look at the longer term benefits of compounding or how markets, your returns will do. What tends to happen is that in India, we tend to be fairly poor on financial literacy. So in a rising market, everyone thinks that, they're fund managers and thinks that, they can make these outsized returns year after year. That's where I think a little bit of the realization comes in when you work with a wealth manager, which is really to try and prevent the accidents from happening. And what we look at is to try and figure out how do you look at risk management better? How do you look at asset allocation, the discipline of investing? And then how do you also look at return enhancement? Because there are going to be pockets of opportunity. And when you do everything yourself, you may miss some of these trends. So the challenges I think we see right now is that there's not enough financial literacy. And therefore, we need to create that investor education. The second challenge, I would say, is actually technology. So to the extent that we've had all this technological advancement, You've also seen recent instances where you've had money heist, typically in digital assets. So when you look at just the security of the assets over a period of time, and if you were to look at data privacy, I think these are the issues that we should be concerned about going forward. So those are the challenges.
Yeah, so challenges are there. Anu, since you are from the legal side here, so how do you see some legal changes which the industry may see going forward?
Thank you, Sachin. So if you were 10 years down the line, I definitely see 5 things should have happened. Supervisory trends are going through the roof, not just with RBI, but with SEBI. I mean, we have our first onboarding ban orders by SEBI. And the penalty there is not crores, it's multi-million loss of business. Markets are maturing. We have to be seen as mature markets. So surveillance data, NSE, BSE, AI, ML, all of those things. UBO, focus increasingly will be a lot on UBO going forward. That's one. Second, you see what happened in Japan, the Toshiba effect. All your big funds no longer will be passive. And we already are seeing, I think next door, there's a sponsor of the next event who has sued a company, right? Domestic mutual funds will have to preserve value, will have a say on board governance, will look at M&A capital allocation. So it's no longer, the promoter. And 1,000-odd resolutions were voted down by Elliott Pimco in Tokyo. Third, I see asset classes collapsing. So far in this topic, you have mutual fund, you have PMS and AIF. I mean, day before only we had the 10 lakh PMS quasi category for mutual funds. I mean, which kind of makes it the whole PMS model. If I have 10 lakh, why would I go 50 lakh? So the lines are no longer clear. Probably you will see them coming closer going forward. Fourth, you will see a lot more of wealth tech regulations, like online bond platform, finfluencers. There's a doubt between research analyst, investment advisor, the whole distribution, origination issue. You will have, already you are seeing discount brokerage pricing norms which came out. And lastly, if you think of exits and change in control, you will probably have more M&A friendly rules, which happened last year with mutual funds, the whole private equity sponsorship norms. So net, my thoughts.
So coming back to you here, Mr. Navneet, now SEBI on Tuesday, it proposed a new segment for retail investors with a cap of 10 lakh. So how do you see that segment taking off? What kind of investors you see there?
By the way, the minimum amount is 10 lakh rupees. So I don't know whether you can say that this is for a retail investor, because the way retail is defined in India. It's interesting. I mean, it's getting discussed that somewhere between MF and PMS, when we look at an asset from an asset manager's perspective or from an investor or wealth manager's perspective, people always talk about the platform, mutual fund, PMS, AIF, institutional, retail, active, passive. I mean, geography, B30, T30, asset class, the private, public, equity, fixed income, money market, alternatives. They should be the way, right? If I think as an asset manager, or let's say a wealth manager, it should be the customer at the center, investor at the center. And what are our core capabilities? Investment management, risk management, and product management, right? Those are the 3 core capabilities. Within that, it should be agnostic to whether we are putting it in an open-ended format or a closed-ended format just because of the regulation or taxation. It's in mutual fund format or that format. This is how it has to be thought. I mean, this is in public domain and it's in consultation paper. We don't know in what form finally it will come, so I won't comment much on that. But my thinking is that every asset manager, just because let's say certain things are allowed in mutual fund format, not that everybody will have that capability and should launch it because there is a demand for it, or the other way around. So I think what SEBI is trying to do, that markets have come of age, investor awareness has increased. While I agree with what Soumya mentioned, that financial literacy is still, I mean, we have a long way to go as a country. country, even among the rich and affluent, not talking about the retail investors, even there, I think there's a lot more that we need to do. At the same time, markets have come of age. I think our capital market infrastructure, where we are today, given the, $5 trillion now, right? I mean, the market cap, the size of the private market, the size of the bond market, now with the bond index inclusion, what it can be over the next couple of years, there is a scope for innovation within the mutual fund space. And given the capability that we have built in terms of talent, in terms of technology, in terms of, and apart from everything else that I talked about, investment management, risk management, and the product management capability, there is a scope for maybe launching products which may have higher, which may have the characteristic of a high risk, high return product. But it has to be sold right, and it has to be marketed right to the right set of investors in the right manner.
Yeah. So what do you think of what kind of funds it can bring to the wealth managers and the new kind of investors you see after this SEBI's new proposed segment?
Sorry, repeat your question, sir.
So what kind of, what's your expectation in terms of, new investors coming in, the size of,
on
or
the
the
10
fund?
lakh.
Yeah,
You're
on the,
sticking to your 10 lakh thing.
yeah, the SEBI's new the segment which it has proposed.
Listen, I think there's a fine balance if you just step back a little bit on what is the right risk for a different type of investors. I don't know the details of the tenor, but I'm assuming the classic definition when you do an AIF product, you minimum put 1 crore. Now you're saying there's a 10 lakh category for more riskier investments. Is that the case? So listen, it's consistent with my earlier thought. It's great to broaden the market and to have many segments. But at the end of the day, what are you trying to do? The whole reason there's a 1 crore minimum on an AIF product is because you assume the person who's putting that amount of money is the equivalent of an accredited investor. His overall net worth should be significantly more than 1 crore for him to put 1 crore into that product. Because, again, the point of diversification, in case that 1 crore goes and crumbles, his lifelong savings is not into that, right? So I think the fact, and that amount is very high if you look at the average wealth that an average Indian family has. So having lower things is obviously a good thing because it gets more and more people into it. My worry, sir, has always been a balance between an introduction of new products versus mis-selling new products. What you don't want to do is come out with a plethora of products which promises the moon to the less sophisticated investor, takes their money, locks it in, provides suboptimal returns, and takes out a lot of fees. That I'm saying is the counter portion of the regulation. So on one hand, it's a very good thing. They're lowering the limit from either 1 crore for AIFs or 50 lakhs for a PMS product to something else for 10 lakhs. I think as an industry, it's our responsibility to ensure that does not create products which are equally safe such that the so-called smaller investor is also well taken care of. So I think it's a balancing of both, which is important.
So Kunal,
could I just come in on that as well? Because I think one of the big things we're looking at in India is really the financialization of assets. So all the discussion around the financialization, which today is about 1 trillion for, let's say, the greater than 1 million segment that has financial assets, that's going to grow at a CAGR of about 13 to 14% over the next 5 years. So you're really saying 1 trillion becomes 2 trillion in 5 years or so. But then that has to be filled by a certain set of products and asset managers who are in a position to actually fill that gap. Today, what does a retail investor have? They only have a mutual fund if they don't want to get, or they don't have the capacity to do a PMS or an AIF. So what you're effectively trying to do is create a category so that you can fill that gap which is going to emerge over the next 5 years. So I think that's a really big part of what the entire wealth management and asset management space is going to look like. 1 trillion to 2 trillion just in the HNI space is a fairly significant amount of money.
So So Kunal, what's your view? That was this new product segment needed for India in this right now, or?
I'll try and keep this really short. I think it's more in the lines of financial inclusion. Now, this is not a product that we at ChrysCapital focus on, but if you look back the last 10 years and say financial inclusion has increased, access to credit has increased, what has it done? It has allowed people who used to go to unorganized money lenders to get organized capital, and as a result of that, they didn't have to pay 3-4% a month. And their cost of capital went down, which helped the common person. I believe, if implemented correctly, what this regulation is doing is ensuring that if you had 10, 12, 15 lakhs to put in, you were earlier going to an unorganized financial intermediary and saying, take my money and do what you want with it. And if it's implemented well, you now have the option to give this higher risk capital, not just pure stock market capital, to someone like HDFC, who will safeguard it, put the right governance and risk controls in place, where you have a better shot at not losing your money, not going into the wrong hands. So I think it actually brings in more inclusion and reduces parallel economy or intermediaries who are not accredited managing other people's money. And that would be a good thing.
Anu, so on the regulation side, so do you feel that this wealth management sector, is it over-regulated and it's stifling innovation?
I mean, Sachin, world over, the space is heavily regulated. I mean, every part of the world. I think if I had a wish list, two things if one could see. One is certainty. I mean, you see close to 80, 90 consultation papers have come out in the last 1 year. One doesn't know, I mean, we as advisors struggle to know what the law is at that point in time. So a bit of clarity in terms of knowing where you stand. Second, 95% of SEBI orders are overturned by SAT. You know, it is just numerically, so it's becoming a bit like tax, right? Which is again not good because, and you have vague definitions. Market manipulation, insider, front running. If you look at surveillance data, you can find 30 people all India who would have punched a trade with the fund manager. I mean, it statistically will happen, right? So just some more clarity in terms of orders, because the settlement powers they have now. I mean, there's a lot of contribution to the Consolidated Fund of India that has been made through settlement amounts. And lastly, what one would want to see is, it's like bad luck is penalized, because the standard I am put, the code of conduct, and the panelists can vouch for this, duty of care, due diligence, what is suitable for the investor. Now, if tomorrow I have a bad investment and it blows up, and it has happened, you look at Franklin Templeton, SL, Amtech, JP Morgan, you can always go back and say you didn't do something right, even though I have followed whatever I could, even including rating agencies. So, and I think that the issue here, especially with us, is a fee-based income model. You have to put equity risk.
Help me understand how this, in the age of Gen AI, how this technology is impacting wealth management sector. And what has been your experience so far? What do you see happening in next couple of years, 5 years now on?
I think if it's on wealth management, I really think, Soumya, do you want to take that one on AI? Sorry to put you on the spot, but in terms of how are you using AI to...
Sure. So I think when we look at Gen AI, couple of places where we think it's going to really be useful. The first is just in terms of a more personalized client experience. So what we're trying to do is that AI can actually sort through large amounts of data. So you have a lot of data in terms of the client. At the same side, you also have a lot of data in terms of product set and availability. What AI is going to do for you is to be able to match off in terms of what is the right strategy for what the client has told you in terms of their risk profile, their risk appetite, their liquidity needs, and so forth. And you can actually tailor it to their requirements specifically. So I think that's a big place where AI will be used. The second is really in terms of just enhanced analytics. because ultimately we have a lot of information which is available on different companies, on different investment opportunities. Now, what you want to use AI for is what would have taken maybe 2 days or 3 days for somebody is going to be done in a matter of seconds, to be able to say that this is the kind of trends that you can see from predictive sense, dislocations in markets which can be predicted. You could also look at scenario analysis, which you can't do otherwise, which would have taken you much longer. So the response time is going to be much faster, which will mean that clients will be able, you will be able to give them better inputs as a wealth manager. So I think these would be two of the big areas where I think AI will make a difference. Of course, the others is really in terms of data entry, automation of processes, rebalancing, compliance checks. But it's a very exciting space. We have started using a little bit of AI on the analytics side, but I think we're just scratching the surface right now.
Well, I would say, so people like us who are on the deployment side, it provides a big opportunity to invest behind teams who are using or developing tools and apps to further this. In fact, if you see the last 6 months, Kunal might have more data because we haven't yet focused on it. But globally, especially in the venture state, more money has gone into AI and the whole AI ecosystem, whether it's chips or apps or other areas, than any other sector, subsector, showing the promise that this has in the coming years.
All right. So, Kunal, would you like to add something to it?
Soumya captured it well, and I think, frankly, we are waiting to see it play out before we really use it, and you need to have a lot of data. So today, it's mainly the hyperscalers who have most of the data who are going to use it the best, but it is a trend that we're going to wait and see how it plays out.
A few words about sustainable investment approach that the ESG coming into this play. What do you have to say about this sustainable investment?
I know we are running out of time a little bit, but I'll just say very quickly, the focus should always be on the substance than the form, right? And so the way we've thought about ESG or any of these initiatives is, does it make sense? Does it make sense for us as a fund manager? Does it make sense for our companies? So a few places in which we have implemented it is where, you're not doing wastage, and therefore you're reducing your power costs, you're reducing your other costs. So it's always good to do it where it makes sense, and when it makes sense, even your portfolio companies will appreciate it and say, this makes sense, I'm going to implement it. And that's been the journey that I think will allow us as fund managers to also have higher credibility than just telling a portfolio company, do this because it is the flavor of the month. And that's how we have been approaching it.
So I think we are running out of time. So I thank all panelists here for their time. Thank you so much, and thanks for your patience.